Imagine walking out to your mailbox on a completely normal Tuesday afternoon. You sift through the usual junk mail, a utility bill, and then your eyes land on a crisp, heavy white envelope from the Internal Revenue Service. You pull out the document, unfold it, and your heart instantly drops into your stomach. Your eyes lock onto a bold, aggressive black number near the top of the page, $48,652. Below it, the text coldly states that this balance is due immediately. Interest is already compounding, and it is the direct result of a newly implemented automated adjustment on the sale of your primary residence. You feel a wave of panic. This has to be an error. You have lived in your home for years, paid your mortgage on time, and followed every traditional rule of homeownership. This exact moment is where the trap snaps shut, because your natural human instinct to call the number on the letter or file a quick amendment is the precise action that guarantees financial ruin. Under the hyper-aggressive tax enforcement systems deployed this year, in 2026, that exact response is flagged by artificial intelligence as a formal admission of non-compliance. It locks you into a computerized audit track where your legal rights are stripped away and the penalty becomes unappealable. You are walking through an invisible financial minefield. If you want to protect your home equity, you must keep watching, because understanding this hidden regulatory shift is the only thing standing between you and absolute financial catastrophe. To understand how we arrived at this dangerous turning point, you have to realize that the IRS did not pass a massive, publicly debated law to strip away tax-free home equity. Instead, they did something far more effective. Over the past 24 months, they quietly overhauled their entire internal enforcement architecture, shifting completely away from traditional, human-driven audits to an advanced, automated transaction matching network. For decades, the Section 121 exclusion legally allowed individuals to protect up to $250,000 and married couples up to $500,000 of profit when selling their main home completely tax-free. It was a simple honor system rule. But now, a massive technological dragnet has been lowered over the entire real estate market. The IRS has integrated its central mainframe with digital state property registries, local utility grid usage databases, postal service logs, and commercial banking networks. They are no longer waiting for a human investigator to look through your files. High-level industry insiders, the elite tax attorneys and institutional wealth managers, understand this system and have already moved their clients' wealth into fortified legal structures. But the average homeowner has been left completely exposed. The most terrifying aspect of this new automated reality is a legal standard known as strict liability enforcement. The system is entirely indifferent to your intentions. It does not care if you did not know the regulation changed. If the automated matching algorithm detects even a single-day discrepancy between your tax filings and your digital footprint, the penalty is assessed instantly, and the entire legal burden of proof is flipped on its head. You must spend months of time and thousands of dollars trying to prove your innocence to a machine programmed to say no. Let us look at the first common trap, which is catching millions of people in the modern remote workforce. Imagine a professional who dedicated a spare bedroom in their house exclusively as a home office. For years, they claimed a modest home office deduction on their annual tax returns, writing off a small percentage of utilities and maintenance. It is perfectly legal and transparent. They eventually decide to sell the house to move closer to family. When the deal closes, the homeowner looks at their total profit, sees that it is well under the exclusion limit, and assumes they owe nothing. They sign the closing documents and do not report the details of the transaction on their next tax filing because they believe it is entirely exempt. They completely ignore a hidden mechanism known as depreciation recapture. What they do not realize is that by claiming that home office deduction, they legally converted a portion of their primary residence into a commercial business asset. The new automated IRS matching system looks at historical tax returns, flags the home office deductions, cross-references them with the property sale reported on Form 1099-S, and instantly notes that no depreciation was recaptured. The system automatically recalculates the entire transaction, strips away the primary residence exclusion from that portion of the house, slaps on an accuracy-related penalty, and generates a massive bill. Fortunately, there is a precise solution to neutralize this trap. When you are preparing to sell a home where a home office was ever claimed, you must determine the exact dollar amount of depreciation you claimed over the lifespan of that office. When you file your taxes for the year of the sale, you must explicitly use IRS Form 4797 and Schedule D to break apart the sale into its residential and commercial components, paying the minor depreciation recapture tax up front to avoid triggering the automated audit flags. If you receive a notice, do not call and speak informally. Instead, your precise written response to the IRS must state exactly this: the property located at the subject address was utilized primarily as a personal residence under Section 121 for the statutory duration. The portion utilized for business purposes did not constitute a separate dwelling unit, and all applicable depreciation recapture under Section 121, subparagraph D, has been fully accounted for on Form 4797, line 12. Providing this exact legal language forces the automated system to route your file out of the machine learning penalty track and into a standard compliance clearance. The second real-world trap involves the move-out and rent strategy. Consider a married couple who bought a starter home, lived in it as their primary residence for 3 solid years, and then decided to buy a larger home. Rather than selling their starter home immediately, they decide to keep it as a rental property to generate passive income, planning to rent it out for exactly 2 years and then sell it. They know the traditional rule states that as long as you lived in the home for 2 out of the last 5 years, you can still claim the capital gains exclusion. The mistake they make is relying on basic calendar dates and assuming the IRS measures residency by the date on a real estate deed or lease agreement. The couple counts their 24 months of renting, puts the house on the market, and closes the sale just a few weeks before that strict 5-year window expires. But behind the scenes, the IRS algorithm pulls the exact date the couple changed the registration on their vehicles, updated their voter registration cards, forwarded their mail, and saw their utility consumption drop at the old property. If those digital markers show they physically vacated the property, even a few days earlier than the official lease began, the system calculates that they fell short of the strict 730 days of physical occupancy required. The system instantly disqualifies the entire exclusion, reclassifies the property as an investment asset, and assesses a massive capital gains tax with a heavy, substantial understatement penalty. To prevent this nightmare, you must treat your residency transition with strict administrative rigor. The absolute moment you move out of a primary residence that you intend to rent, you must create a physical and digital residency paper trail. Secure a certified final utility reading, an official moving confirmation letter, and a dated copy of your tenant's signed lease. When it comes time to sell that property within the allowable window, instruct your closing escrow officer in writing to issue a split Form 1099-S. If the IRS automated system flags the transaction and issues a deficiency notice, reply via certified mail with a precise written statement that reads exactly as follows: I am writing to contest the automated adjustment for the tax year in question. The taxpayers physically occupied the subject property as their principal residence for a total of 730 days within the 5-year period preceding the date of sale, satisfying all physical presence tests under Internal Revenue Code Section 121. Supporting contemporaneous documentation, including certified utility records, voter registration histories, and vehicle compliance logs, are attached hereto as Exhibit A. This legal pushback establishes an ironclad defense that the automated algorithms are forced to accept. The third everyday scenario is a heartbreaking trap because it stems from parental love. Look at the situation of parents who want to help their child purchase their first home. The mortgage lender informs the family that the loan can only be approved if the parents agree to co-sign the mortgage and hold title to the property alongside their child. The parents gladly agree, and their names are placed on the property deed as 50% owners. The child moves into the home, lives there for 4 years as their sole primary residence, pays every expense, and eventually decides to sell the home, generating a $100,000 profit. The mistake made by this family is assuming that because the home was exclusively used as the child's primary residence, the entire transaction is covered by the primary residence tax exclusion. The parents do not pocket any money from the sale. When the house closes, the title company issues a Form 1099-S listing the parents' names and social security numbers. The parents do not report the sale on their own tax returns because they believe they have nothing to declare. This is exactly where the IRS automated underreporter system strikes. The algorithm scans the form, sees the parents' names, and notices they failed to report the sale. Because that property was not the parents' primary residence, the automated system completely denies them the Section 121 exclusion for their 50% share, automatically issuing a massive tax bill directly to the parents for capital gains they never received. To eliminate this vulnerability, you must alter the ownership framework before the property is put on the market. Ideally, you should execute a legally valid quitclaim deed to remove your name from the title prior to the tax year of the sale. If your name must remain on the title through closing, you must establish a principal agent constructive trust agreement before any listing agreement is signed, stating that your name is on the deed purely as a financing accommodation. At the closing table, use this exact spoken script with the closing agent. We require the Form 1099-S for this transaction to be issued entirely under the primary occupant's Social Security number, reflecting 100% of the equitable ownership and allocation of proceeds to the primary resident, as authorized by IRS guidelines for nominee reporting. If the IRS still issues a notice, your written response must state exactly this: the taxpayer held bare legal title to the subject property solely as a financing guarantor and nominee. The taxpayer retained zero equitable interest, contributed no capital, and received zero proceeds from the transaction. The primary occupant maintained sole equitable ownership and physical residency under Section 121, and all reporting has been properly allocated under nominee rules. This completely neutralizes the automated penalty mechanism. The fourth scenario deals with home improvements. Consider a family that has owned their home for 15 years and spent $80,000 overhauling the kitchen, replacing the roof, and adding a deck. They know that every single dollar spent on a permanent capital improvement legally increases their property's cost basis, which reduces their taxable profit when they eventually sell. The mistake they make is frequently hiring local independent contractors who offered a substantial discount if paid in cash or through digital payment apps. The family kept a folder filled with handwritten receipts and material invoices. 15 years later, they sell their home for a massive profit. When preparing their tax return, they manually calculate their adjusted basis by adding that $80,000 of renovations to the original purchase price. But under the newly deployed IRS automated audit systems, this triggers an immediate red flag. The automated system scans the reported adjusted basis, compares it to the original purchase price, and notices an unexplained jump. Because there is no corresponding corporate reporting matching that $80,000 basis increase, the algorithm automatically disallows the entire renovation amount. The IRS issues an automated assessment denying the basis adjustments, reclassifying the money as pure taxable profit, and slaps the homeowner with a heavy penalty. To protect your equity, you must implement a digital verification protocol for every single improvement. For any renovation, you must maintain a digitized capital improvement ledger. If you paid a contractor in cash years ago and only have a fading paper receipt, you should send a formal written request to that contractor stating exactly this: I am updating the federal tax compliance records for my property basis ledger. Please provide a formal signed statement on your company letterhead confirming the total dollar amount received for capital improvements, the specific dates of service, and a brief description of the permanent structures installed at my address. If they cannot be reached, compile your bank statements showing the cash withdrawals, match them to time-stamped photographs of the renovation progress, and file a detailed itemized basis statement attached directly to your return. If the automated system challenges your basis, your written legal response must state exactly this: the taxpayer has adjusted the property cost basis in strict compliance with Internal Revenue Code Section 1016 to reflect permanent capital improvements that prolong the life and increase the value of the asset. Contemporaneous financial records, bank transaction logs, and photographic verifications of construction are attached as definitive proof of basis adjustment. This precise, systematic proof forces a manual clearance of your account. Now that you understand the automated dragnet, you need an immediate defense. We are going to implement the 5-minute shield, a single practical task you can execute today to permanently safeguard your home equity. Right after this video ends, open your primary cloud storage account and create a brand new folder labeled exactly Master Property Basis and Residency Vault. Inside this folder, establish a permanent digital checklist containing exactly 3 items. First, snap a high-resolution digital photograph of your current driver's license, voter registration card, and most recent utility bill showing your name and property address. This establishes an unassailable, time-stamped digital baseline of your physical residency. Second, create a blank spreadsheet labeled Capital Improvement Ledger and bookmark it on your phone. From this moment forward, every single time you buy hardware, replace an appliance, or pay a technician, take a 5-second photo of the receipt and log the dollar amount. Third, log into irs.gov and pull your secure account transcript for the past 3 years to verify that the federal government's master database lists your home address with flawless accuracy. This simple setup creates an ironclad digital armor around your single largest financial asset. The information I have shared with you today is not something you will hear from traditional news outlets, because the automated systems rely on public ignorance to generate billions of dollars in easy penalty revenue. That is why I am asking you to completely bypass the standard like and subscribe buttons today. Instead, take the link to this video right now and send it directly to your friends, family members, or coworkers who currently own a home or are considering moving. Sending this single link could be the exact intervention that saves a loved one from years of agonizing financial stress or the complete loss of their life savings to an unappealable tax penalty. We have to look out for each other and protect our circles from these silent regulatory traps. Once you have shared this video, come back to the comment section below and participate in our community discussion. Please share your personal experiences. Have you or anyone in your immediate circle ever been hit with an unexpected tax notice or penalty after a property transaction? Are you currently utilizing a home office deduction or managing a rental property under the current rules? Drop your thoughts, your questions, and your stories below. Stay vigilant, protect your equity, and I will see you in the next video.